If you enjoyed this audiobook, please consider liking, sharing, and subscribing to the channel. Sharing it with your friends and family helps spread knowledge, and when we help others grow, we grow too. Thank you so much for listening. Let's dive into the audiobook. Chapter 1: Firm Foundations and Castles in the Air. Part 1: Firm Foundations and Castles in the Air. When IBM's stock price soared to $607 per share in 1961, only to crash to $300 18 months later, investors learned a harsh lesson about the two fundamental forces that drive every stock market transaction: cold calculation and hot emotion. Every stock purchase reflects one of two competing philosophies that have battled for supremacy since markets began. The firm foundation theory suggests that every stock possesses an intrinsic worth based on its ability to generate future earnings and dividends. Think of Benjamin Graham meticulously calculating asset values in the 1930s, treating stocks like pieces of a business rather than lottery tickets. This approach views market prices as temporary deviations from true value, eventually correcting themselves as rational analysis prevails. Yet markets rarely behave with such mathematical precision. The castle in the air theory recognizes a different reality. Stock prices depend largely on what other investors think they should be worth. John Maynard Keynes compared this to a newspaper beauty contest where judges don't pick the most beautiful face, but rather the face they believe other judges will select. Success requires predicting crowd psychology, not corporate fundamentals. Consider the technology stock phenomenon of the late 1990s. Amazon's price-to-earnings ratio reached astronomical levels that no fundamental analysis could justify. Traditional value investors watched in bewilderment as dot-com companies with minimal revenues commanded billion-dollar valuations. Yet those who understood crowd dynamics recognized that investor enthusiasm, not earnings projections, was driving prices skyward. Both theories contain essential truths. Warren Buffett built his fortune identifying undervalued companies with strong fundamentals, proving that intrinsic value eventually surfaces. However, even Buffett acknowledges that markets can remain irrational longer than investors can remain solvent. His early investment in Coca-Cola succeeded not just because the company had solid fundamentals, but because other investors eventually recognized that value. The most successful investors understand both forces. They recognize that short-term price movements often reflect sentiment shifts rather than business realities. A quarterly earnings miss might trigger selling that has nothing to do with long-term prospects. Conversely, positive news coverage can inflate prices beyond reasonable valuations. Smart money doesn't choose between these theories, but leverages both. During market panics, when castle-in-the-air thinking turns pessimistic, solid companies trade below their intrinsic values. Conversely, when euphoria grips markets, even mediocre businesses can command premium prices from optimistic buyers. The key lies in recognizing which force dominates at any given moment. Are investors focused on spreadsheets and cash flows, or are they swept up in stories and momentum? The answer determines whether you should trust your calculator or your sense of crowd psychology. Part 2: The Madness of Crowds. When 17-year-old Dutch sailor Adrian Coppens paid 6 months' wages for a single tulip bulb in 1637, he believed he had secured his financial future. Within weeks, tulip prices collapsed by 95%, and Coppens lost everything. This pattern would repeat countless times throughout history, proving that human nature remains remarkably consistent across centuries. The most striking feature of speculative manias isn't their unpredictability. It's how predictably they follow the same script. During the dot-com bubble of 1999 to 2000, investors abandoned traditional valuation metrics for companies with no revenue, much as Dutch merchants once ignored agricultural fundamentals for flower bulbs. Pets.com burned through $300 million in 2 years, selling dog food online at a loss, yet reached a market value of $290 million before its inevitable collapse. The company's business model defied basic economics. but investors were too caught up in internet fever to notice. Charles Mackay documented this phenomenon in his 1841 work, Extraordinary Popular Delusions, noting how men go mad in herds while they recover their senses slowly and one by one. Modern neuroscience confirms Mackay's observations. Brain imaging studies show that when people make financial decisions in groups, the regions associated with critical thinking become less active, while areas linked to emotional processing light up like Christmas trees. Consider the GameStop phenomenon of 2021. Retail investors on Reddit drove shares from $4 to $483 in weeks, not because the struggling video game retailer had transformed its business model, but because collective enthusiasm created its own momentum. Professional investors who tried to short the stock based on fundamental analysis lost billions as social media-driven buying continued far longer than rational models predicted. The recurring nature of these manias reveals something profound about human psychology. Each generation believes it has discovered something genuinely new. Internet stocks in 1999, housing in 2006, cryptocurrency in 2017. Each time, participants convinced themselves that traditional rules no longer applied. This time is different becomes the rallying cry of every bubble, despite being what John Templeton called the 4 most expensive words in investing. What makes crowd behavior so dangerous isn't just the initial euphoria, it's how quickly sentiment can reverse. During the 1929 crash, stocks that had been celebrated as sure winners became untouchable overnight. RCA, the Tesla of its era, fell from $114 to $2.50 in 3 years. The same psychological forces that drove prices up accelerated their descent. The lesson isn't to avoid markets entirely, but to recognize when crowd psychology has disconnected prices from reality. When your barber starts getting stock tips, when new investment products promise guaranteed riches, when traditional valuation methods are dismissed as outdated, these signals suggest it's time to step back and let others learn expensive lessons about the madness of crowds. Part 3. Stock Valuation Through the Decades. When Burton Malkiel tracked stock valuation methods across 3 decades of investing, he discovered something remarkable. Each generation of investors believed they had finally cracked the code to market success, only to watch their foolproof strategies crumble when conditions changed. The 1960s through 1990s revealed how dramatically valuation approaches could shift with economic tides. The 1960s belonged to growth stock enthusiasts who dismissed traditional metrics like price-to-earnings ratios as relics. Companies like Xerox and IBM commanded astronomical valuations based purely on their growth potential. The Nifty 50 stocks, including Coca-Cola, McDonald's, and Polaroid, traded at PE ratios exceeding 50, with analysts arguing that quality growth stocks deserved any price. This philosophy worked brilliantly until it didn't. When the 1973-74 bear market struck, these former darlings lost 70 to 90% of their value. The late 1970s and early 1980s ushered in an obsession with asset-based valuations. With inflation ravaging the economy, investors focused on companies with tangible assets: real estate, oil reserves, and manufacturing equipment. This approach seemed logical when inflation reached double digits. But it proved inadequate as the economy transformed towards services and technology. The personal computer revolution of the 1980s created entirely new valuation challenges. How do you price Microsoft when its primary assets walk out the door each evening? Traditional book value metrics became meaningless for software companies with minimal physical assets but enormous earning potential. Meanwhile, the decade's merger mania introduced takeover premiums as a new valuation benchmark, with companies trading based on their acquisition potential rather than operational fundamentals. Perhaps no period better illustrated valuation evolution than the late 1980s Japanese stock bubble. Toyota traded at 60 times earnings, while Japanese banks commanded price-to-book ratios exceeding 5. analysts created new metrics to justify these prices, arguing that traditional Western valuation methods couldn't capture Japanese companies' true worth. The subsequent collapse eliminated $2 trillion in market value, proving that fundamental valuation principles transcend cultural boundaries. The 1990s democratized stock analysis through personal computers and financial software, yet this technological advancement often led to overconfidence rather than better outcomes. Investors armed with spreadsheets and historical data convinced themselves they could predict future performance with mathematical precision. Each decade's dominant valuation approach reflected the era's economic conditions, technological capabilities, and regulatory environment. Growth investing thrived during economic expansion. Asset-based approaches gained favor during inflationary periods, and new methodologies emerged alongside technological breakthroughs. The critical insight from this historical survey isn't that certain valuation methods are inherently superior, but rather that markets continuously evolve, rendering yesterday's surefire strategies obsolete. Successful long-term investors adapt their analytical frameworks while maintaining healthy skepticism toward any single approach that claims to have solved the valuation puzzle permanently. Part 4. The Sanity and Folly of Institutions. When Fidelity Magellan's Peter Lynch stepped down in 1990 after 13 years of spectacular returns, the fund had grown from $20 million to over $14 billion. Lynch's departure marked more than just a career milestone. It highlighted a broadly uncomfortable truth about institutional investing that few wanted to acknowledge. Even the most successful fund managers eventually become prisoners of their own success, forced to manage assets so large that their best ideas get diluted into market-matching mediocrity. The institutional investing world operates under a paradox that would be comical if billions of dollars weren't at stake. These professional money managers, armed with teams of analysts, Bloomberg terminals, and direct access to company executives, consistently struggle to outperform simple index funds. A 2019 Spiva study revealed that over 15 years, roughly 90% of actively managed funds failed to beat their benchmark indices. This isn't a recent phenomenon. Similar patterns have persisted for decades. Consider the case of long-term capital management, where Nobel Prize-winning economists and seasoned Wall Street veterans created what they believed was a foolproof trading strategy. Their sophisticated mathematical models and academic credentials couldn't prevent a spectacular collapse in 1998 that required a $3.6 billion bailout. Intelligence and resources, it turned out, provided no immunity against market humility. The problem runs deeper than individual failures. Institutional investors often move in herds, creating the very inefficiencies they claim to exploit. During the late 1990s tech boom, fund managers who ignored internet stocks faced career-ending underperformance, even when their skepticism proved correct. This created a vicious cycle where rational analysis took a backseat to relative performance anxiety. Quarterly reporting requirements compound this challenge. While Warren Buffett can ignore short-term market fluctuations at Berkshire Hathaway, most fund managers face constant scrutiny from investors who judge performance every 3 months. This pressure transforms long-term value investors into short-term momentum chasers, regardless of their personal investment philosophy. The compensation structure further distorts decision-making. Fund managers typically earn fees based on assets under management, not performance. A manager overseeing a $5 billion fund collecting 1% annually earns $50 million regardless of whether investors make money. This creates perverse incentives where gathering assets becomes more important than generating returns. Perhaps most tellingly, many institutional investors privately acknowledge these realities. CalPERS, the massive California pension fund, shifted significant portions of their portfolio to index funds after years of underperformance from active managers. Even institutions tasked with beating the market increasingly recognize that consistent outperformance remains elusive, regardless of professional credentials or analytical resources. This institutional behavior creates profound implications for individual investors. Rather than viewing professional management as a guarantee of superior returns, smart investors recognize that even experts struggle against market efficiency. The next logical question becomes whether there are systematic approaches that can provide more reliable outcomes than active management's hit or miss record. Chapter 2: The Case Against Market Prediction, Part 1. Technical Analysis Exposed. When Charles Dow created his famous theory in 1884, he likely never imagined that traders would spend fortunes on software promising to predict market movements through chart patterns. Today's technical analysts claim they can forecast stock prices by studying historical data, but decades of research suggest they're chasing mirages in the desert of financial markets. Technical analysis operates on a seductive premise. Past price movements reveal future directions. Practitioners draw support and resistance lines, identify head and shoulders patterns, and calculate moving averages with religious devotion. They speak of breakouts and momentum as if stocks were governed by the same laws that control rolling balls down hills. The reality proves far different. In 1988, researchers Andrew Lowe and Craig McKinley tested the predictive power of technical trading rules on stock market data spanning several decades. Their findings were devastating for technical analysts. The strategies showed no consistent ability to generate profits after accounting for transaction costs and risk. Even more damaging, when the same rules were applied to randomly generated price sequences, they produced similar patterns and signals. Consider the case of Valuation, the investment advisory service that ranks stocks based on technical and fundamental factors. Despite their sophisticated ranking system and decades of refinement, academic studies consistently show that their top-ranked stocks fail to outperform the market after adjusting for risk and transaction costs. The fundamental flaw in technical analysis lies in its assumption that price patterns repeat predictably. This ignores how markets actually function. When IBM announced its partnership with Microsoft in 1981, no chart pattern could have predicted the resulting price surge. Similarly, when Enron's accounting fraud emerged in 2001, technical indicators provided no warning of the company's collapse. Professional traders often point to successful practitioners like Paul Tudor Jones or George Soros as evidence that technical analysis works. However, these examples suffer from survivorship bias. For every celebrated technical trader, thousands of others lost money using identical methods. We simply don't hear about the failures. The efficient market hypothesis provides a more compelling explanation for technical analysis's poor track record. If chart patterns truly predicted future prices, rational investors would quickly exploit these patterns, eliminating any profit opportunity. The very act of discovering a profitable pattern destroys its effectiveness. Perhaps most damning is the scientific evidence. Multiple studies comparing technical trading strategies to simple buy-and-hold approaches consistently show that after accounting for taxes, commissions, and market impact, technical analysis fails to deliver superior returns. The patterns that appear so convincing to the human eye are often statistical noise masquerading as meaningful signals. This doesn't mean technical analysis lacks all value. It can help investors understand market sentiment and identify potential entry points for long-term positions. However, treating it as a reliable prediction tool transforms investing into expensive gambling. Part 2. The Flaws in Fundamental Analysis. When Zacks Investment Research analyzed over 160,000 earnings estimates from Wall Street professionals in the 1990s, they discovered something remarkable. These highly educated, well-connected analysts were wrong about quarterly earnings predictions nearly 75% of the time. Even more troubling, their forecasts became less accurate the further out they attempted to predict. This sobering reality exposes a fundamental problem with what many consider the most logical approach to investing. Fundamental analysis appears deceptively rational. The process involves studying company balance sheets, income statements, competitive positioning, and industry trends to determine a stock's true value. When market price falls below this calculated intrinsic worth, the theory suggests buying the undervalued security. This approach attracted legendary investors like Benjamin Graham and continues drawing millions of individual investors who believe diligent research will reward them with superior returns. The mathematical elegance of fundamental analysis masks a critical flaw. Information travels at light speed in modern markets. Consider the case of Enron, where accounting irregularities remained hidden despite thousands of analysts studying the company's financials. Conversely, when Apple announced the original iPhone in 2007, the stock price immediately jumped 8% within hours, instantly incorporating the news into the share price. This rapid adjustment leaves little opportunity for individual investors to capitalize on publicly available information. Professional analysts face additional handicaps that retail investors rarely consider. Industry studies consistently show that earnings forecasts demonstrate systematic biases. Analysts tend toward excessive optimism, particularly for companies their firms have investment banking relationships with. A Harvard Business School study found that analysts' buy recommendations outnumber sell recommendations by a ratio of 6-to-1. Revealing an inherent conflict of interest that skews research quality. The forecasting challenge becomes exponentially difficult when extending beyond single quarters. Predicting next year's earnings requires accurate assumptions about economic conditions, competitive dynamics, regulatory changes, and countless other variables. Amazon's transformation from online bookstore to cloud computing giant illustrates how quickly fundamental assumptions can shift. Traditional retail analysis would have missed this evolution entirely. Even perfect fundamental analysis faces timing problems. Value investing patriarch Warren Buffett famously holds stocks for decades, yet individual investors often lack such patience. A stock trading below intrinsic value might remain undervalued for years, testing even disciplined investors' resolve. During the dot-com bubble, value-oriented managers significantly underperformed growth strategies for several consecutive years, despite ultimately being proven correct. Market efficiency theory suggests that thousands of professional analysts armed with sophisticated models and instant access to information create a competitive environment where mispricings quickly disappear. The paradox emerges. If enough people believe fundamental analysis works and act upon it, their collective actions eliminate the very opportunities the analysis was meant to identify. This self-defeating mechanism explains why consistently beating market averages through fundamental research remains so elusive for both professionals and individual investors alike. Part 3. The Random Walk Theory. When Princeton economist Burton Malkiel first proposed that a blindfolded monkey throwing darts at stock pages could select portfolios performing as well as expert-chosen ones, he wasn't making a joke. He was describing mathematical reality that Wall Street desperately wants you to ignore. The random walk theory rests on a simple yet profound observation. Stock price movements follow no predictable pattern. Just as a person wandering randomly through a park might go left, then right, then forward without any discernible logic, stock prices move up and down in ways that resist forecasting. This isn't opinion. It's mathematical fact supported by decades of rigorous testing. Consider what happened when the Wall Street Journal actually conducted Malkiel's dart-throwing experiment in the 1990s. Professional money managers competed against randomly selected stops for over 14 years. The results were sobering. The random portfolios won nearly as often as the professionals. And when transaction costs were factored in, the monkeys effectively won more frequently. The statistical foundation becomes clear when examining price change correlations. If patterns existed in stock movements, today's price changes would correlate with yesterday's or last week's changes. extensive analysis of major stock exchanges reveals correlation coefficients hovering around zero, meaning no relationship exists between past and future price movements. IBM's 3% gain today tells you absolutely nothing about tomorrow's direction. Why does randomness dominate? Markets process information with remarkable speed. When Amazon announces better than expected earnings, thousands of computers execute trades within milliseconds. By the time humans read the news, prices have already adjusted. The only thing moving prices after full information absorption are genuinely unpredictable events, a surprise FDA approval, an unexpected geopolitical crisis, or a CEO's sudden resignation. Professional fund managers understand this reality more than they admit publicly. Peter Lynch, legendary manager of Fidelity's Magellan Fund, acknowledged that successful stock picking often resembled educated guessing. Even Warren Buffett, perhaps history's most successful investor, advocates index funds for most people precisely because consistent market beating proves so difficult. The mathematical proof extends beyond individual stocks. Studies tracking mutual fund performance over 20-year periods show that funds beating the market in one decade rarely repeat that performance in the following decade. Hot hands cool off. Yesterday's genius becomes tomorrow's cautionary tale. This randomness doesn't mean investing is hopeless. Quite the opposite. It means that instead of chasing the impossible dream of prediction, smart investors accept randomness and build strategies around it. The market's random walk leads upward over time, rewarding patient investors who stop trying to outsmart the system and instead harness its long-term growth potential through diversified, low-cost approaches that work with randomness rather than against it. Part 4. The Efficient Market Hypothesis. When Warren Buffett bet hedge fund manager Ted Seides $1 million in 2007, that a simple S&P 500 index fund would outperform a collection of hedge funds over 10 years, most Wall Street professionals scoffed. By 2017, Buffett's passive approach had crushed the hedge funds, proving what academic researchers have known for decades. Markets process information so efficiently that beating them consistently is nearly impossible. The efficient market hypothesis forms the theoretical backbone of this reality. Developed by Eugene Fama at the University of Chicago, EMH proposes that stock prices instantly reflect all available information. Think of the market as a massive crowd of analysts, investors, and algorithms, all racing to find the same $20 bill lying on the ground. The moment someone spots it, they grab it, and the opportunity vanishes for everyone else. This process happens thousands of times daily across global markets. When Apple announces quarterly earnings, within milliseconds, computers digest the numbers, compare them to expectations, and adjust the stock price accordingly. By the time individual investors hear the news on television, the information is already baked into the price. Professional fund managers face the same challenge, despite their armies of analysts and sophisticated research tools. Fama's research earned him a Nobel Prize because the empirical evidence overwhelmingly supports EMH. Studies tracking thousands of mutual funds over multiple decades reveal a sobering pattern. Fewer than 25% of actively managed funds beat their benchmark indices over any 10-year period. Even more striking, the funds that do succeed rarely repeat their performance in subsequent decades. Consider the famous case of Peter Lynch, who managed Fidelity's Magellan Fund from 1977 to 1990 and achieved legendary returns. Lynch seemed to prove EMH wrong, generating annual returns exceeding 29%. However, after Lynch retired, subsequent managers struggled to match his performance despite using similar strategies. This pattern repeats across the industry, suggesting that exceptional performance often reflects luck rather than skill. The implications extend beyond individual stock picking to entire investment strategies. If markets efficiently price securities, then expensive research departments, frequent trading, and complex algorithms primarily generate costs rather than returns. The average actively managed mutual fund charges fees of 1% annually, while comparable index funds cost 0.05%. Over 30 years, this difference compounds dramatically, often exceeding the value of any potential outperformance. Critics argue that market bubbles and crashes disprove EMH, pointing to the dot-com bubble or 2008 financial crisis as evidence of irrational pricing. However, these events actually demonstrate EMH's sophistication. Markets can be efficient at incorporating available information while still experiencing volatility based on changing economic conditions and investor sentiment. The hypothesis doesn't claim markets are always correctly priced, only that prices reflect the collective wisdom of all participants given current information. This understanding transforms investing from a game of prediction into a strategy of participation, where success comes from owning broad market segments rather than trying to outsmart them. Chapter 3: Bubbles, Manias, and Human Psychology. Part 1: Historic Speculative Bubbles. When crowds chase extraordinary returns, history suggests they're walking toward extraordinary losses. From tulip bulbs in 17th century Amsterdam to mortgage-backed securities in 2008, the patterns remain remarkably consistent across centuries and cultures. The South Sea Bubble of 1720 offers perhaps the most instructive example of collective financial madness. The South Sea Company, granted exclusive trading rights with South America, saw its stock price rocket from £100 to over £1,000 in just months. Isaac Newton himself lost £20,000 in the collapse, later remarking he could calculate the motions of heavenly bodies, but not the madness of people. The company's actual trading profits? Virtually non-existent. What drove otherwise rational individuals to pour life savings into a company with no real business? The same psychological forces we see repeated across every major bubble. Early investors made genuine profits, creating visible success stories that spread through coffee houses and social circles. As prices climbed, the fear of missing out intensified. People borrowed against their homes, sold family heirlooms, and convinced themselves that traditional valuation methods no longer applied. The 2008 housing crisis followed an eerily similar script. Between 2000 and 2006, median home prices in cities like Las Vegas and Miami doubled or tripled. Mortgage brokers assured buyers that housing prices never decline nationally, echoing the tulip merchants who insisted bulbs were different this time. Exotic financial instruments like collateralized debt obligations became the modern equivalent of South Sea Company stock splits, designed to create artificial scarcity and excitement. Alan Greenspan later admitted the Federal Reserve failed to recognize the bubble because they believed market participants were acting rationally. This reveals a fundamental truth about bubbles. They feel rational from the inside. Each participant can point to seemingly logical reasons for their behavior, yet the collective result defies all logic. The warning signs are consistent across bubbles. New era thinking emerges, suggesting traditional metrics don't apply. Borrowed money floods the market as leverage amplifies both gains and eventual losses. Media coverage shifts from skepticism to celebration, with success stories drowning out cautionary voices. Spotting bubbles requires fighting your own psychological wiring. When taxi drivers offer stock tips or your neighbor quits their job to flip houses, markets may be approaching dangerous territory. The most important question isn't whether assets will continue rising, but whether you can afford to be wrong. History's lesson is clear. No asset class, no matter how innovative or revolutionary, is exempt from the laws of gravity. The internet revolutionized commerce. But that didn't justify internet stocks trading at infinite price-to-earnings ratios in 2000. Real estate provides shelter and appreciates over time, but that didn't justify assuming it could never decline nationwide. The investors who survive bubbles intact share one common trait: they maintain healthy skepticism even when everyone around them embraces certainty. Part 2: Behavioral Finance, Biases and traps. When Daniel Kahneman won the Nobel Prize in Economics in 2002, he wasn't an economist at all. He was a psychologist. His work revealed that human beings consistently make predictable errors when handling money. Errors so systematic they could be measured and studied. This revelation fundamentally changed how we understand financial markets and why smart people make terrible investment decisions. The human brain operates like a survival machine designed for a world that no longer exists. When our ancestors heard rustling bushes, those who assumed danger and ran away lived longer than those who stopped to analyze whether it was wind or a predator. This hardwiring creates what psychologists call loss aversion. We feel the pain of losing money roughly twice as intensely as the pleasure of gaining the same amount. Consider how this plays out in practice. Terence Odian, a finance professor at UC Berkeley, analyzed the trading records of 10,000 individual investors over 7 years. He discovered that people held losing stocks 50% longer than winning stocks. Investors would sell their winners to lock in gains while clinging to losers, hoping they would recover. This behavior directly contradicts rational decision-making but makes perfect psychological sense. Overconfidence presents an even more dangerous trap. Odian found that men traded 45% more frequently than women, yet earned 2.65 percentage points less annually. The most active male traders underperformed the market by 11% per year after accounting for trading costs. These weren't inexperienced investors. They were educated professionals who genuinely believed their research and instincts gave them an edge. The herding instinct compounds these individual biases into market-wide distortions. When everyone around you is making money in technology stocks or real estate, questioning the trend feels foolish. FOMO, fear of missing out, becomes a powerful force. Jeremy Grantham of GMO Asset Management calls this the pain of watching your neighbor get rich. Professional investors aren't immune. A study by Lubos Pastor and Robert Stambaugh found that mutual fund managers consistently chase performance, pouring money into asset classes after they've already risen substantially. Fund flows into equity funds peak precisely when stock valuations are highest and markets most vulnerable. Understanding these biases offers a path forward. Warren Buffett famously keeps a clipping in his wallet that reads, "The time to buy is when blood is running in the streets." This isn't bravado, it's a systematic approach to counteract natural human tendencies. The solution isn't to eliminate emotions, but to build systems that work with human psychology rather than against it. Automatic investment plans remove timing decisions from the equation. Written investment policies force you to define your goals when thinking clearly, not during market panics. Recognition represents the first step toward rational investing. Your brain will always whisper seductive stories about why this time is different, why your stock pick is special, why you can time the market. The question is whether you'll listen. Part 3. Modern Market Anomalies. When Eugene Fama won the Nobel Prize in 2013 for his efficient market hypothesis, something remarkable happened. Robert Shiller, who spent decades documenting market irrationalities, shared the same award. This paradox captures perfectly where financial markets stand today, caught between theoretical efficiency and stubborn real-world patterns that refuse to disappear. The evidence has been mounting for decades. Eugene Fama and Kenneth French documented in 1993 what became known as the three-factor model, showing that small-cap stocks and value stocks consistently outperformed their theoretical risk-adjusted expectations. This wasn't a short-term fluke. From 1926 to 1991, value stocks delivered annual returns roughly 5% higher than growth stocks, even after adjusting for risk. The pattern has persisted across different time periods and international markets, creating what academics call the value premium. Momentum investing presents an even stranger challenge to market efficiency. Narasimhan Jagadish and Sheridan Titman's landmark 1993 study revealed that stocks performing well over the past 3 to 12 months tend to continue performing well for several more months. This contradicts the random walk theory completely. If markets were truly efficient, past performance would offer no predictive value. Yet momentum strategies have generated consistent excess returns across multiple decades and asset classes. Consider the case of AQR Capital Management, founded by Cliff Asness in 1998. The firm built its reputation systematically exploiting these market anomalies through quantitative strategies focused on value and momentum factors. By 2020, AQR managed over $140 billion, largely by betting against market efficiency. Their success isn't accidental. It's based on documented patterns that persist despite widespread knowledge of their existence. The persistence of these anomalies raises uncomfortable questions. If smart money should eliminate inefficiencies, why do value and momentum premiums endure? Behavioral explanations offer compelling answers. Value stocks often represent companies in distress or unfashionable industries. Investors systematically avoid them due to loss aversion and representativeness bias, the tendency to extrapolate recent poor performance indefinitely into the future. Meanwhile, momentum exists partly because investors initially underreact to new information, then overreact as trends become obvious. But here's the critical caveat that Malkiel emphasizes. Knowing these anomalies exist doesn't guarantee you can profit from them. The value premium disappeared almost entirely from 2007 to 2020, causing many investors to question whether it had become arbitraged away. Transaction costs, timing issues, and the psychological difficulty of holding unfashionable stocks can easily erode theoretical advantages. The implications for practical investing are nuanced. These anomalies suggest that markets aren't perfectly efficient, but they're efficient enough that exploiting inefficiencies requires considerable skill, patience, and resources. For most investors, acknowledging these patterns while maintaining humility about their ability to consistently profit from them represents the wisest approach. The market may not be perfectly random, but it remains largely unpredictable for individual investors trying to time short-term movements. Part 4. Lessons from Recent Financial Crises. When legendary fund manager David Swensen lost $4.3 billion of Yale's endowment in 2008, he discovered that even the most sophisticated institutions weren't immune to the basic human tendencies that create financial disasters. The dot-com crash and the 2008 crisis serve as stark reminders that market vulnerabilities stem not from complex financial engineering alone, but from fundamental flaws in how we think about risk. The dot-com bubble of 1999 to 2000 revealed how quickly rational analysis can be abandoned when everyone seems to be getting rich. Pets.com spent $300 million on marketing while generating less than $620,000 in sales. Yet investors poured money into the company because the story felt compelling. Henry Blodgett, the star internet analyst at Merrill Lynch, privately called stocks he publicly recommended pieces of junk while rating them as strong buys. This disconnect between private skepticism and public enthusiasm created a feedback loop that inflated valuations to absurd levels. The 2008 financial crisis exposed different but equally dangerous patterns. Banks like Lehman Brothers were leveraged at ratios of 30-1, meaning a tiny 3% drop in asset values would wipe out their entire capital base. Yet, risk models consistently showed these positions as safe because they relied on historical data that didn't capture the possibility of nationwide housing price declines. When Bear Stearns collapsed in March 2008, their risk management systems had assigned a probability of less than 1 in 10,000 to such an event occurring. Both crises shared common elements that repeat throughout financial history. Excessive leverage amplified small problems into systemic failures. Risk models based on recent data failed to account for extreme scenarios. Most importantly, the human tendency to extrapolate recent trends into the future led both professionals and individual investors to make catastrophic decisions. Consider the behavior of supposedly rational institutional investors. In 2007, pension funds and endowments were allocating unprecedented amounts to alternative investments, like hedge funds and private equity, chasing the higher returns these strategies had recently delivered. When markets collapsed, these illiquid investments became anchors that dragged down portfolio performance for years. The lesson isn't that markets are fundamentally broken, but that they remain vulnerable to the same psychological forces that have driven bubbles and crashes for centuries. Even sophisticated mathematical models and professional management can't eliminate the human element from investing. The most effective protection remains the boring fundamentals: maintaining diversification across asset classes, avoiding excessive leverage, and accepting that no one can consistently predict when markets will turn. These crises remind us that periods of apparent stability often breed complacency, creating conditions for the next disaster. The most dangerous moment for investors isn't when markets are obviously volatile, but when everyone believes they've figured out how to eliminate risk entirely. Chapter 4: The Intelligent Investor's Toolkit, Part 1: Modern Portfolio Theory and Diversification. When Harry Markowitz received the Nobel Prize in Economics in 1990, few people realized his groundbreaking work would fundamentally change how ordinary investors think about risk. His modern portfolio theory proved mathematically what savvy investors had suspected for centuries. You don't have to sacrifice returns to reduce risk if you know how to build your portfolio properly. The magic happens through correlation, or rather, the lack of it. When technology stocks crashed in 2000, real estate investment trusts gained 26%. During the 2008 financial crisis, while the S&P 500 lost 37%, government bonds returned positive gains. This isn't coincidence. It's the power of combining assets that move differently under various market conditions. Think of correlation like a dance partnership. When two investments are perfectly correlated, they move in lockstep like synchronized swimmers. Beautiful to watch, but offering no protection when markets turn sour. Uncorrelated assets, however, perform their own independent routines. While one stumbles, another might shine. The mathematics behind this phenomenon seems almost too good to be true. By combining just two uncorrelated investments with identical expected returns, you can reduce risk by up to 30% without sacrificing potential gains. Add more uncorrelated assets, and the benefits compound. This is why Yale's endowment, managed by David Swenson, spreads investments across domestic stocks, international equities, bonds, real estate, and commodities, achieving remarkable long-term performance with lower volatility than traditional portfolios. The key insight challenges our intuitive thinking about risk. Most people assume more investments mean more complexity and potentially more problems. But statistical analysis reveals the opposite. Risk actually decreases as you add uncorrelated holdings. Following a mathematical relationship where total portfolio risk falls below the weighted average of individual investment risks. Consider the simple example of owning both Coca-Cola and umbrella manufacturing stocks. When sunny weather boosts Coke sales, umbrella sales typically suffer. During rainy seasons, the reverse occurs. Neither investment alone provides stability, but together they create a more predictable income stream. The practical application requires understanding what drives different asset classes. Stocks generally respond to economic growth expectations, bonds to interest rate changes, commodities to inflation pressures, and real estate to demographic trends. By holding positions across these categories, you're essentially betting on the overall progress of civilization rather than the success of any particular sector. Modern portfolio theory transforms investing from gambling into engineering. Instead of picking individual winners, you're building a machine designed to capture market returns while minimizing the bumps along the way. The goal isn't eliminating risk entirely. That would eliminate returns too. Rather, it's about taking only the risks that pay you to accept them, while diversifying away the risks that don't add value. Part 2: Index Funds versus Active Management. When Jack Bogle founded Vanguard's first index fund in 1976, Wall Street mocked it as Bogle's Folly. Critics claimed that settling for average returns was unambitious. Why accept mediocrity when skilled managers could beat the market? 4 decades later, that mediocre fund has outperformed roughly 85% of actively managed funds, turning the investment world's assumptions upside down. The mathematics behind this reversal are brutally simple. Active management operates like a high-stakes casino where the house always wins. Fund managers typically charge 1 to 2% annually in fees, while index funds cost as little as 0.03%. Over 20 years, a 1.5% fee difference compounds into a 35% reduction in total returns. Even if an active manager picks stocks brilliantly, those fees create a massive headwind that few can overcome. Consider the legendary Peter Lynch, who managed Fidelity Magellan from 1977 to 1990. His 29% annual returns made him a Wall Street icon. Yet academic research by Dalbar shows that the average investor in Lynch's fund earned only 7% annually during the same period. Why? Investors bought high after reading about Lynch's success and sold low during market downturns. They turned a winning fund into a losing proposition through poor timing. This behavioral gap reveals a fundamental flaw in active management's premise. Even if managers could consistently identify undervalued stocks, and decades of evidence suggest they cannot, investors still struggle to capture those returns. John Templeton, himself a renowned stock picker, admitted late in his career that he wished he had simply bought the market through an index fund. The data supporting passive investing has become overwhelming. Morningstar's annual active passive barometer consistently shows that low-cost index funds outperform their actively managed peers across virtually every category and time horizon. In 2023, only 24% of domestic equity funds beat their index benchmarks over 5 years. The longer the time frame, the worse active management performs. Active managers face an impossible task. They compete against other professionals with access to the same information, sophisticated analysis tools, and substantial resources. For every manager finding an undervalued stock, another equally skilled manager is selling it. This creates what economists call a zero-sum game before fees and a negative-sum game after fees. The solution isn't complicated. A simple portfolio of low-cost index funds capturing different market segments delivers the market's return while minimizing costs and eliminating manager risk. You're guaranteed never to underperform the market significantly, which is more than most active strategies can promise. Sometimes the most intelligent approach is acknowledging that trying to be clever often makes you foolish. Like active management performance, you're guaranteed never to underperform the market, which is more than most active strategies can promise. Sometimes the most intelligent approach is acknowledging that trying to be clever often makes you foolish. Part 3. Behavioral Guidance for Investors. When Warren Buffett famously bet that an S&P 500 index fund would outperform a collection of hedge funds over 10 years, he wasn't just proving a point about fees. He was demonstrating the power of behavioral discipline. By 2017, his simple index fund had crushed the hedge funds. But the real lesson wasn't about returns. It was about how the most dangerous enemy of investment success sits between your ears. The human brain wasn't designed for investing. Our ancestors who survived were those who reacted quickly to immediate threats, not those who could calmly evaluate long-term probabilities. This evolutionary wiring creates predictable patterns that cost investors dearly. When markets crashed in March 2020, Vanguard reported that individual investors made 4 times as many transactions as usual, mostly selling at exactly the wrong moment. Professional institutional investors, they barely increased their trading at all. Consider the behavior of everyday investors during the 2008 financial crisis. While the S&P 500 fell roughly 37%, the average equity mutual fund investor lost over 40% according to research firm Dalbar. The difference? Panic selling and poor timing decisions. These same investors missed much of the subsequent recovery because fear kept them on the sidelines. The antidote to emotional investing isn't willpower, it's systems. Dollar cost averaging transforms market volatility from an enemy into an ally. When you invest the same amount regularly, regardless of market conditions, you automatically buy more shares when prices are low and fewer when they're high. During the dot-com crash from 2000 to 2002, investors who continued their systematic contributions were buying shares at increasingly attractive prices, setting themselves up for significant gains during the recovery. Market volatility feels personal, but it's actually quite normal. Since 1950, the S&P 500 has experienced corrections of 10% or more approximately once every 2 years. Yet over any 20-year rolling period, the market has never produced negative returns. This statistical reality should comfort long-term investors, but our brains focus on recent losses rather than historical patterns. The most successful investors develop what psychologists call process focus rather than outcome focus. They concentrate on controllable actions, maintaining diversification, minimizing costs, and staying disciplined, rather than unpredictable results like next quarter's returns. Ray Dalio built Bridgewater Associates into the world's largest hedge fund by creating systematic rules that remove emotion from investment decisions. Your investment strategy should be boring enough to stick with during both euphoria and panic. When everyone around you is either celebrating or panicking, remember that the market's daily movements are largely random noise. The signal, long-term wealth creation through owning productive businesses, emerges only over years and decades, not days and weeks. Part 4. The life cycle approach to personal investing. When a 25-year-old software engineer allocates 90% of her portfolio to stocks, she makes a fundamentally different calculation than a 65-year-old approaching retirement. Age transforms how we should think about money, yet most investors treat their portfolios as if time stands still. Your investment strategy should evolve alongside your life circumstances. Target date funds demonstrate this principle in action. Vanguard's 2065 fund holds roughly 90% stocks for young investors, while their 2025 fund maintains only 50% equity exposure. This shift reflects a mathematical reality. Younger investors can recover from market crashes because they have decades to compound their returns, while older investors need preservation more than growth. Consider the case of David Bach, who documented his financial journey from his 20s through his 50s. In his early career, Bach invested aggressively in growth stocks and rode out the 2000 tech crash without panic selling. By age 45, he had shifted toward more balanced allocations, recognizing that his timeline for major expenses like college tuition had shortened dramatically. The life cycle approach extends beyond simple age-based formulas. Young professionals should prioritize building emergency funds before aggressive investing. Financial planner Suze Orman learned this lesson after losing $50,000 in her 20s by investing borrowed money. Your human capital represents your largest asset early in life, making disability insurance more critical than complex investment strategies. Middle-aged investors face competing priorities that require careful balance. Harvard economist David Laibson studied household financial behavior and found that Americans typically hit peak earning years between 45 and 54, yet simultaneously face maximum financial stress from mortgages, college costs, and aging parents. During this phase, tax-advantaged accounts like 401ks and IRAs become particularly valuable tools. Pre-retirees must shift focus from accumulation to withdrawal planning. William Bengen's research on safe withdrawal rates showed that retirees could historically withdraw 4% annually from balanced portfolios without depleting principal. However, sequence of returns risk, experiencing poor market performance early in retirement, can devastate even well-planned portfolios. Smart lifecycle investing also recognizes that risk tolerance changes with experience. Yale's Robert Shiller observed that investors who lived through the 1970s inflation maintained different asset preferences throughout their careers compared to those who started investing in the 1990s bull market. Your personal history shapes your comfort with different investment approaches. The most successful lifecycle investors automate their strategies. Fidelity's research shows that accounts with automatic contributions and rebalancing achieve returns 2.3% higher than those requiring manual intervention. Set systems that adapt gradually to your changing circumstances, rather than making dramatic shifts based on short-term market movements or life events. This systematic approach transforms investing from a series of isolated decisions into a coherent long-term plan that serves your evolving needs across decades.